Good morning. Welcome to the Consumer Financial Protection Bureau's public meeting of its Consumer Advisory Board, or CAB, as we like to call it, in downtown Tampa, Florida. The Consumer Financial Protection Bureau is an independent federal agency whose mission is to help consumer finance markets work by making rules more effective, by consistently and fairly enforcing those rules, and by empowering consumers to take more control over their economic lives. As part of the Bureau's mission to protect consumers, to date, we have handled over 1.2 million complaints, and our actions have resulted in nearly $12 billion in relief to more than 29 million consumers. My name is Ixta Martinez. I serve as the Associate Director for the External Affairs Division at the Consumer Bureau. Today's meeting is being held at the Hilton Tampa Downtown Hotel in Tampa, Florida. This is the CAB's third meeting of the year, and as always, we have a packed schedule. Today's meeting is being live streamed at consumerfinance.gov, and a recording will be made available on the same website. You can also follow CFPB on Facebook and Twitter. Let me spend a few minutes telling you what you can expect at today's meeting. First, I'll introduce the CAB members. Then the Consumer Bureau's Director, Richard Cordray, will provide opening remarks. Following the Director's remarks, Hector Ortiz, Policy Analyst in the Bureau's Office for Older Americans, will engage the CAB in a discussion about the Consumer Bureau's Know Before You Owe initiative on reverse mortgages. Then at 11:15 a.m., the CAB will hear from Yannicka Radcliffe, Assistant Director for the Bureau's Office of Financial Education. She will lead a discussion about financial well-being in the U.S. After that discussion, the CAB will adjourn at approximately 12:15 p.m. At 2 p.m., the CAB's chair, Ann Bador, will resume the meeting. CAB members Josh Zinner and Ohat Summit will lead a discussion about trends and themes in the field. Following that discussion, the CAB will hear from David Silberman, the Bureau's Acting Deputy Director and Associate Director for the Research, Markets, and Regulations Division. David will lead a discussion about the Bureau's final rule for payday, vehicle title, and certain high-cost installment loans. After the discussion, there will be an opportunity to hear from members of the public. The Dodd-Frank Wall Street Reform and Consumer Protection Act, which created the Consumer Bureau, also provided for the establishment of the Consumer Advisory Board to advise and consult with the CFPB in the exercise of its functions and to provide information on emerging practices in the consumer financial products or services industry, including regional trends, concerns, and other relevant information. Today's meeting and discussion is in support of this statutory responsibility. As a reminder, the views of the CAB member are their views, and they are greatly appreciated, yet they do not represent the views of the CFPB. So let's get started with an introduction of our CAB members. I ask CAB members to raise their hand when I call their name. The chair is Ann Bador. She is the director of the Fair Financial Services Program at Texas Appleseed in Austin, Texas. The vice chair is Lynn Drysdale. She is the managing attorney of the Consumer Law Unit at Jacksonville Area Legal Aid in Jacksonville, Florida. Randy Edelstein is the assistant director counsel for regulatory affairs at MasterCard International in Purchase, New York. Seema Agnani is the Executive Director for Asian Pacific American Community Development in Washington, D.C. Sylvia Alvarez is the Executive Director at the Housing and Education Alliance in Tampa, Florida. Patricia Arvielo is the President and co-founder of New American Fundy in Tustin, California. Tim Chen is the CEO of NerdWallet in San Francisco, California. Kathleen Engel is a research professor at Suffolk University Law School in Boston, Massachusetts. Judith Fox is a clinical professor of law at the University of Notre Dame in Notre Dame, Indiana. Neil Hall is retired, having previously served as the Executive Vice President and Head of Retail Banking at the PNC Financial Services Group in Pittsburgh, Pennsylvania. William Howell is the Head of U.S. Retail Banking at Citibank in New York City. Brian Hughes is the Executive Vice President and Chief Risk Officer at Discover Financial Services in Riverwoods, Illinois. Julie Kalkowski is the Executive Director for the Financial Hope Collaborative at Creighton University in Omaha, Nebraska. Ruhi Maker is a Senior Attorney at the Empire Justice Center in Rochester, New York. Brent Neiser is Senior Director at the National Endowment for Financial Education in Denver, Colorado. Ohat Summit is the CEO of One True Holding Company in San Francisco, California. Lisa Servan is a professor of city and regional planning at the University of Pennsylvania in Philadelphia, Pennsylvania. Dr. Howard Slaughter is the president and CEO of Habitat for Humanity of Greater Pittsburgh in Pittsburgh, Pennsylvania. James Wayman is the executive vice president of SCORES at the Fair Isaac Corporation in Roseville, Minnesota. Chi-Chi Wu is a staff attorney at the National Consumer Law Center in Boston, Massachusetts. And Joshua Zinner is the CEO of the Interfaith Center on Corporate Responsibility in New York City. We also have with us today Gail Hillebrand, Associate Director for the Bureau's Consumer Education and Engagement Division, and Delicia Han, Assistant Director for the Bureau's Advisory Board and Counsel's Office. I'm now pleased to introduce Richard Cordray. Prior to his current role as the Consumer Bureau's first director, he led the CFPB's Enforcement Office. Before that, he served on the front lines of consumer protection as Ohio's Attorney General. In this role, he recovered more than $2 billion for Ohio's retirees, investors, and business owners, and took major steps to help protect its consumers from fraudulent foreclosures and financial predators. Before serving as Attorney General, he also served as an Ohio State Representative, Ohio Treasurer, and Franklin County Treasurer. Director Cordray?
Thank you, Zixta, and welcome everyone. Good morning. I'd like to thank the Tampa community for hosting us so graciously and all of you for being here today. Since we established the Consumer Advisory Board, which we know as the CAB, 5 years ago, we've made sure that its membership spans the nation. We also make it a point to travel outside of Washington, D.C. to learn more about consumers in different parts of the country. Yesterday, we learned about this city's history and visited a retirement community to hear more about the particular challenges facing constituencies such as older Americans. And I want to make a particular thank you to Sylvia Alvarez and Lynn Drysdale for organizing the tour we had of the community yesterday. We've also had the opportunity to hear how natural disasters affect this community from time to time, in particular recent storms such as Irma and Maria. When these catastrophes occur, they can have multiple cascading effects, including financial effects. It can be hard to know whom to trust and where to look for guidance and help, as well as what financial steps to take as individuals and communities begin recovery. And that will be true in Texas and Puerto Rico as well. We shared that the Consumer Bureau offers various resources and tools, including toolkits for consumers who are victims of hurricanes and other natural disasters. These resources can help consumers figure out how to address their most urgent financial needs and warn them away from common scams and fraudulent schemes that always spring up in the wake of natural disasters. Our dialogue with our CAB members helps improve the ways that consumer financial markets work for American consumers. The board is a diverse group that identifies key issues cropping up around the country and presents broader perspectives on issues that sharpen our approach to consumer financial protection. Today, I will share some information about our recent work, and we will all seek your input as well. Issues that affect the financial security of older consumers are of great interest here. Florida is often known as the retirement state because it is home to over 4 million Americans who are age 65 or older. In fact, just 60 miles north of here in Sumter County, I'm told that over half the residents are seniors. Since the Bureau was established in 2010, we've adopted a consistent framework around much of our work in consumer education and engagement. We call this approach and initiative Know Before You Owe, meaning that before consumers make important decisions and take on financial responsibilities, they should be informed about the costs and risks and terms of those choices. Over the years, this effort has produced useful resources and new consumer-friendly disclosures in a number of areas. Late this summer, we added to this framework by releasing a report about the costs and risks of using reverse mortgages to delay collecting Social Security benefits. The report responded to an increasing promotion of this strategy by financial writers and those in the reverse mortgage industry, often without discussing all of the costs and risks involved. The CFPB analyzed this strategy using different scenarios and found that the cost of a reverse mortgage usually exceeds the extra benefits that would be gained by delaying Social Security retirement benefits from age 62 until full retirement age. We also found this strategy can hurt borrowers by diminishing the home equity available to them later in life. As a result, those who follow this strategy to sell their homes may be unable to relocate or to handle a financial shock. We will be discussing this further, and in particular, we'd be glad to hear from you about how we can get this information across to more consumers around the country who may be facing these same circumstances. In addition to our focus on reverse mortgages, we will also engage on a topic about which the CAB has provided much feedback over the last several years, which is our research on measuring and understanding the factors that affect consumers' financial well-being. These prior conversations have covered two main topics. First, there was the Bureau's research to establish a consumer-driven definition of financial well-being. Second was our work to develop a reliable and validated set of questions and create a scale to measure individual financial well-being. Our most recent milestone in this research, ongoing research, released in September, was our report on financial well-being in America, which discusses the results of a nationwide survey that measured this phenomenon. The survey showed that people's sense of financial well-being varies widely, including within the same age cohorts and racial and ethnic groups, as well as when people are grouped by levels of income and education. The results also reveal the difficult financial circumstances of many consumers, with more than 40% of U.S. adults reporting that they struggle to make ends meet in a typical month. We also released an interactive online tool that allows people to measure their own levels of financial well-being, and a data set for public use that allows researchers to explore how financial well-being relates to other factors. All of these matters will be open for discussion today, and we're interested to hear from you about your other ideas you may have to further our ongoing research in this important area. We are also mindful of the financial obstacles faced by Americans with limited English proficiency. In a recent survey, Spanish-speaking Americans identified home ownership as their top financial goal. In fact, Latino American home ownership has grown steadily since 2010, even as overall home ownership decreased nationwide. At the same time, we know this group of consumers often has thinner credit files and makes less use of banks and credit unions. We want to help these individuals and families achieve their dream of home ownership by equipping them with the information, steps, and tools they need. So we're reaching out to Spanish-speaking Americans who aspire to future home ownership and encouraging them to use banks, credit unions, and financial products to build up their positive credit history. In so doing, we're helping this population lay the foundations for future home ownership. To see our latest offering, and I will not do this as well as Zixta would, but Como Preparas para Comprar una Casa, how to get ready to buy a home, if you didn't understand my Spanish translation, visit our Spanish website at cfpb.gov/es. From consumer advocates around the country, we've been hearing that outreach into immigrant communities is especially important right now. So once again, we're interested in your thoughts about how we may enable more consumers and their families to benefit from this new resource. Payday, auto title, and other similar loans have been of continued interest to the CAB over the last several years. Earlier last month, we issued a new rule addressing widespread debt traps in the credit markets for these products and for longer-term balloon payment loans. The core principle of our rule rests on the basic principle of requiring lenders to make a reasonable assessment up front of whether people can afford to repay these loans. It also curtails repeated attempts to debit checking accounts that rack up fees and make it harder for consumers to get out of debt on both short-term and longer-term loans. These protections bring needed reform to a market where far too often lenders have succeeded by setting up borrowers to fail. Payday and vehicle title loans often are marketed heavily to financially vulnerable consumers. Although they offer access to credit for cash-strapped consumers, the requirement that these loans must be repaid in full can make them unaffordable. If a borrower living paycheck to paycheck needs such a loan to cover basic expenses or recover from a large expense or drop in income, they will probably face the same shortfall when they get their next paycheck. Only now they have the added cost of loan fees or interest. Faced with unaffordable payments, consumers must choose between defaulting, reborrowing, or failing to pay their major financial obligations or basic living expenses. Many borrowers in this difficult situation end up rolling over or refinancing their loans again and again. More than 4 out of 5 payday loans are reborrowed within a month, usually right when the loan is due or soon thereafter. About 1 in 4 initial loans are reborrowed 9 times or more, as consumers pay far more in fees than they borrowed in the first place. People have similar experiences with auto title loans, and 1 out of 5 borrowers end up having their car or truck seized by the lender because they cannot repay the debt. This cycle of piling on new debt to pay back old debt can turn a single unaffordable loan into a long-term debt trap. It is a bit like getting into a taxi for a ride across town, then finding yourself stuck in a ruinously costly cross-country journey with no exit ramps. With each renewed loan, the consumer pays more fees or interest on the same debt. The consequences are severe. Even those who renew the loan repeatedly and at great cost may still wind up in default and get chased by debt collectors or have their car or truck repossessed or lose their accounts. In fact, our research has shown that the business model for payday and auto title lenders is built on miring people in debt in this way. Lenders actually prefer customers who will reborrow repeatedly rather than simply repaying the loan when it comes due. That way they can continue collecting fees or interest as long as the borrower does not fully repay. And where lenders make repeated attempts to debit payments from their accounts, that can add significant penalties as overdue borrowers get hit with multiple fees and may even have their bank accounts closed. Our rule takes square aim at these practices. They're the subject of intense public interest, as we received about 1.4 million public comments on the proposed rule. Later today, we'll be hearing from David Silberman, our acting deputy director, who will lay out more of the details of the final payday rule. We intend to have a conversation that sheds light on the need, as we see it, to ensure that consumers have access to safe products and ensure that they are both supported and protected in using these products. So thank you again for being here, and we look forward to all of the discussions today on these issues and on any others you would like to raise. Thank you.
Thank you, Director Cordray, and welcome to this fall meeting of the Consumer Advisory Board. Since 2012, when the CAB was established, small dollar lending, both access to safe small dollar products and restrictions on predatory products, has featured as a discussion item for the CAB. As Director Cordray just presented to you earlier last month, the Bureau finalized its rule on small dollar loans, and this is our first opportunity to provide feedback and input to the Bureau. Today's meeting focuses on some very important topics such as reverse mortgages, financial well-being, debt collection, and small dollar lending. To get us started, I'd like to welcome Hector Ortiz from the Office of Older Americans. This summer, the Bureau released a report examining the costs and risks of using a reverse mortgage to delay collecting Social Security benefits. Hector will walk us through the report's findings, and then we'll take feedback from the CAB. Hector?
Oh, thank you again, and good morning, everyone. I'm with the CFPB's Office for Older Americans. Our office works to protect older consumers, defined as those who are age 62 and older, but we also work with those professionals and family members who support them in order to protect them from financial harm and to support their financial decision-making on those issues and decisions that are important for their later life economic security. Therefore, decisions about home equity and Social Security, one of the two most important resources that older consumers have, are of great interest to our office. Since the Consumer Advisory Board establishment in 2012, our office has proactively sought feedback on a number of issues and work streams from this committee, and our feedback has always been incorporated throughout our work. Our presentation today focuses on the finding of our August 24th report on the cost and risk of using a reverse mortgage. Before I begin, I would like to disclaim that my presentation does not constitute legal interpretation or guidance from the Bureau, and any opinions and views are my own and may not represent necessarily the views of the Bureau. Our recent work on reverse mortgages and Social Security builds on our previous work on reverse mortgage advertising. In our reverse mortgage ad study, we found that consumers who read and heard many reverse mortgage ads had huge misconceptions about reverse mortgages. Specifically, some consumers were confused about the costs and risks of borrowing a reverse mortgage, such as they thought it was government benefits, so not loans that had to be repaid. Some thought that reverse mortgages proceeds were tax-free, therefore borrowers did not have to pay property taxes, and that they cannot lose their homes from a reverse mortgage. As we continue monitoring this market and identify areas where consumer education was of great value in order to help consumers make informed decisions, we're specifically interested in one growing promotion for a use of a reverse mortgage, and that is to delay the collection of Social Security benefits. As we read blogs, articles on these topics, what we found was that many financial professionals, writers, whether it was in those blogs and books and pieces, were often missing a discussion on the risks and costs associated with this strategy. And furthermore, only a few of those really specify under what circumstances such strategy could work. Before I discuss the specific findings of our report, I want to briefly talk about the importance of Social Security and the claiming decision, but also the importance of home equity, particularly in today's retirement landscape and for those who are approaching retirement. It's not a surprise when maximizing Social Security will be an attractive goal to many Americans retiring today. About 85% of consumers 65 and older receive income from Social Security. And on average, Social Security accounts for 63% of the income of those beneficiaries who are 65 and older. But as you age, it becomes even more important. And so for those beneficiaries who are 80 and older, Social Security accounts for 71% of their income. We also know that Social Security is likely to be an even more important source of income for those who are approaching retirement today, as a growing number of them are expected to reach retirement with limited savings and without a traditional pension. That means that Social Security is likely to be the only source of guaranteed regular income that is also protected against inflation. In 2015, the average Social Security monthly benefit was $1,300 a month. Approximately 40% of eligible individuals who claim Social Security do so at age 62. And about 75% even before what Social Security calls their full retirement age, thereby receiving what we know is a permanent reduction in their benefits. And one way in which individuals can increase their monthly income is by waiting to collect their benefits until their full benefit age or up to their full retirement, their maximum claiming age, which is age 70. For those who are born after 1960, the reduction for claiming at age 62 can be as much as 30% of the benefit that they're entitled. When a consumer makes an informed decision about when to claim Social Security, not only they're boosting their monthly paycheck and their monthly income, they could also be boosting their lifetime amount. And that is the case because consumer today, those who live to the average life expectancy of a 62-year-old, that is approximately age 85, will receive more money over their life course from an increased benefit for a shorter amount of time than getting a smaller benefit for a longer amount of time. Let me just now quickly talk about the importance of home equity. We saw already the savings shortfall and the importance of Social Security. On the other hand, the home equity is the other important financial resource that older consumers have. In 2016, 80% of those who are 65 and older own their homes. A significant portion of them, and we have noted this in previous work, with a mortgage, and 70% without. Home equity, compared to other financial resources, is the most valuable asset for the largest number of older consumers. In fact, in 2016, home equity accounted for 20% of all the assets held by older consumers. Home ownership provides affordable housing in retirement, but also is a source of potential liquid savings. And one way in which consumers can tap that equity is through borrowing against the equity through a reverse mortgage. We know specifically that a reverse mortgage loan is a very unique type of loan for those who are 62 and older, where the consumer doesn't have to repay the loan until the last borrower dies or moves from the home, as long as they live in the home, maintain the home in good repair, and pay the real estate taxes and homeowners insurance. Now, one strategy that, again, professionals are trying to promote is that links these two common sources is to borrow at age 62 in order to delay claiming Social Security until their full retirement age, which depends. It could be 66 or 60, up to 67, depending again on the date of birth, or even to their maximum claiming age of age 70. To examine the costs and risks and trade-offs of this strategy, we looked at a series of scenarios that quantified the reverse mortgage for a hypothetical retired homeowner and compared those against the expected additional lifetime benefits from delaying Social Security from age 62 and until age 67. And we looked at the lifetime by the average life expectancy. We made other assumptions that I'm happy to discuss in more detail in our discussion, including the average home value of $175,000 and an interest rate of 5.9%. Our first finding is that in general, a reverse mortgage loan cost, that is the origination cost, the interest, mortgage insurance premiums, and the fees, will exceed the additional amount of money in lifetime Social Security benefits that a homeowner will realize. Let's talk briefly about what is that amount, that lifetime amount in Social Security benefits. So for example, a homeowner with an expected benefit of $900, about $910 at age 62, that delays claiming Social Security until age 67 will get $1,300 a month. Given the average life expectancy of a 60-year-old today is age 85, this homeowner is likely to receive a cumulative benefit in today's dollars that is about $30,000 more by age 85 if that person again claims at 67 rather than age 62. In other words, the benefit here is $30,000. The next thing that I want to talk about is how much are they borrowing in order to delay. So we're assuming here that the individuals borrowing basically the principal amount of the reverse mortgage loan is the amount of money that the borrower will have received from Social Security between the ages of 62 and 67, and that is $54,600. And we're assuming that the borrower, again, is taking a line of credit feature and in equal installments of $900 over the course of that 5-year period. So now let's look at the cost. We know that a homeowner that borrows a reverse mortgage is receiving loan proceeds secured by their home during the period of delay. And in doing so, they're assuming debt not just for the principal amount, but also the interest, mortgage insurance premiums, servicing fees. But we also know that most people, in fact, 99%, will also roll the upfront cost, the origination and closing costs into the reverse mortgage costs. And those are also factored in these numbers. And what we find is that by age 67, when they're starting to collect their Social Security benefit, the loan balance already will be $76,000, and by age 85 will be $233,000. Now, if we compare just those costs against the $30,000 that we saw earlier, what we find is that we go age by age from all the way age 67 to 85. What we find is that at a given age, this becomes a cost to the consumer. As you can see here at age 69, which is the average life of a loan, the average tenure of a loan, the costs of a reverse mortgage exceed the additional benefit by about $2,000. By age 85, the average life expectancy, the costs exceed the additional benefit by $149,000. However, there is one particular instance here where you can see a benefit for the consumer, a net benefit of $8,000, and that is those who pay off the loan immediately. Now, paying off the loan immediately also raises a question: who can do it? And as we know, many older consumers, those whose home is their main asset, are unlikely to have other resources to pay the loan immediately, will have to do so by selling their homes. And in fact, the study from Stephanie Moulton what found is that those homeowners who obtain and retain a reverse mortgage had less than $21,000 in non-housing assets. So there's certainly this is a decision that once you make, most likely you will not be able to get out unless you sell your home. In addition to this finding, we basically looked at the basics, how much it costs to borrow those $54,000. And as we can see, by age 67, the costs are about 40% of that principal borrowed. By age 69, it's 60%. But by the average life expectancy, you're looking at 3 times the cost of the amount borrowed. Now, the other thing that is a little bit more difficult to predict for many consumers, and that is whether or not they will be able to stay in their homes until their death and to their life expectancy. And that raises a risk for those who have to sell their homes and need the proceeds to buy a new home and to also handle a large financial shock, whether it's long-term care or other need that requires a large infusion of cash. And that is that the borrowing of a reverse mortgage at such an early age will be reflected in the reduced home equity that homeowners will have in their homes. And this is, again, problematic if it becomes desirable to sell the home. Consider the example of a typical 62-year-old with a home, again, worth $175,000, and that home is appreciating at a 4% rate per year. Because the interest rate here is 5.9, the home value will be about $213,000 at age 67 and $430,000 at age 85. So their equity is increasing over time, but that loan balance is increasing much faster. And what's happening is that homeowner will only owe 64% of the total value at age 67, and by age 85 will owe only 46% of the home. And this is so dependent on appreciation rates. If that home is appreciating at a lower rate, like a 2% rate, and we know from studies that that's more aligned with older consumers' home appreciation rates, the risk is bigger. And what you're seeing is by age 85, the consumer will only owe about 16% of the home value. And again, this is just using the reverse mortgage to do that small delay at the beginning. These were our two main findings. We're certainly looking forward to your feedback on this and having more discussion of assumptions and other items. But I want to also share with you other two resources that were released that same day that are related to this idea of informing consumer of cost and risk. And one of them was a video and a discussion guide that we put together. The video was another example of the collaborative work in the Bureau between our office and our technology office and other units. And I would like to play this short video for you.
Are you or someone you know considering getting a reverse mortgage? A reverse mortgage is a type of loan for homeowners age 62 and older, often used to help pay for living expenses. Here's how they work. With a reverse mortgage, you borrow money against the equity in your home. Instead of paying interest and fees each month, they are added to your loan balance. As the loan balance grows, your home equity shrinks. Once the last borrower no longer lives in the house, the loan must be paid back. But you will pay no more than the value of the house. Keep in mind, you can lose your home if you don't meet the loan requirements. Unlike a traditional mortgage, you have no monthly mortgage payments, but you are still responsible for paying your property taxes and homeowner's insurance and maintaining your home. If you can't pay these expenses, or if you stop living in your home for most of the year, you can lose your home to foreclosure. A reverse mortgage is not a government benefit. The loan is made by a private lender, and it must be paid back. You'll need a plan for your future. Think about your future housing and financial needs. On average, a 65-year-old is likely to live another 20 years or more. Down the road, you may want to live in a smaller house or move closer to family. If so, a reverse mortgage may not be right for you because you'll need to pay off that growing loan balance when you sell your home and may not have enough left to buy a new home. Also, borrowing a reverse mortgage at a young age can be risky. Later in life, you're more likely to have less income and higher healthcare bills, which could be a problem if you run out of loan proceeds. To learn how reverse mortgages work and whether they are the right option for you, check out the CFPB's Reverse Mortgage Discussion Guide.
Thank you again for playing the video. I also want to share with you briefly another important resource that we developed, also dealing with one strategy, a selling point on reverse mortgages, which is the notion that reverse mortgages are a product to age in place, and the blog provides things to consider for consumers about this concept of aging in place. And one of the particular notions that we challenge is that aging in place means exactly staying in your own home. The other work that we have done is we certainly looked at our complaints, and we have summarized the issues that we find, and common issues that older consumers and their family members face with reverse mortgages. We published a report in 2015, but more recently in May, the CFPB published a report focused on all the complaints from older consumers, and it has a subsection on reverse mortgages. And lastly, we are very interested in the claiming decision itself, and we have created a tool to help consumers navigate this important decision, particularly those who are thinking of it early on and thinking about how to map their retirement process. We worked in collaboration with the Social Security Administration. Our tool is award-winning plain language. It was developed to make this important and very complex decision easy to understand. It's available in Spanish, and more importantly, it's our recognition, again, of the importance of the financial capability challenge involved in this important decision. I want to move now to the discussion. I just want to say that we got a lot of feedback from media and the industry, and our critics even have acknowledged that we have made a huge public service by engaging in this debate. And as a result of the discussions generated in this issue brief, we're seeing precisely what we need, which is the level of specificity as to whom and under what circumstances a strategy like this can work. And many people have said and come out and said that this is not a standalone strategy. This is not a strategy to be done as a do-it-yourself, even as those are big warnings coming out from those financial professionals, and that it needs to be done with a professional with the best interests of the consumer. Now I want to move to hear from CAB members, and we're certainly interested in this work, but also generally in what we can do to support older homeowners understand both the potential risk and benefits of using home equity in general to supplement retirement income. Thank you.
Thank you so much, Hector. So now we're going to move to the CAB discussion. And so Josh, would you like to start us out?
Yeah, thanks so much, Hector. This is really important work and is going to be really beneficial to a lot of older Americans. Just to flag a few other issues that arise, which I'm sure you're well aware of, but just to put them on the table. The reverse mortgages can make a lot of sense for certain people, but there's also a lot of very aggressive push marketing of reverse mortgage products. And one of the things that we see is that people are in an attempt to maximize what they're getting back on the reverse mortgage. Their spouses are not written onto the mortgage, and this, of course, increases what they get back. But what a lot of people don't understand is that then when they pass, their spouse is facing foreclosure, and that's a big issue. Also, a lot of lower income families that we've seen through the years have their children living in the home. And they don't have a full understanding when they're entering into these reverse mortgages that when they pass, that's going to put their children out on the street unless they can refinance. And in most of these situations, the children who are living in the home adult children don't have the capacity to refinance and then lose that home that they've lived in that's really the only source of family wealth often. And that finally, we've been seeing, and advocates in New York have been seeing a lot of issues around servicing on reverse mortgages, and particularly where people fall behind on their taxes and insurance. Instead of working with the homeowner to resolve those issues, enter into payment plans on the taxes, et cetera, certain servicers, not all, but certain, are moving very quickly to foreclosure and putting seniors at risk of losing their homes when they entered into the reverse mortgage believing that that would give them the opportunity to live in their home for the rest of their lives. So those are issues that we're seeing that are worrisome.
Brent?
Yeah, Brent Neiser, National Endowment for Financial Education. This is an outstanding study, and we've come so far in the claiming information about Social Security. So it really goes to that level. Folks in this setting have to think about a couple fundamental questions. Where are they going to live, and how are they going to pay for their retirement life, for which may include some part-time work? I'm going to give you a few comments about anchoring numbers, and I think a lot of what we're facing is a question of sequencing. What follows what? And here your study shows the importance of keeping that, trying to delay claiming Social Security, the benefit of that, but the cost of doing a reverse mortgage before Social Security is really out of sequence and could be very inappropriate. Some of us call this a bridging strategy. So as you're not working as much, how do you bridge to your financial life to claim Social Security later? And really, reverse mortgages should happen after the Social Security claiming decision, because you need that capacity for medical bills and as many things that Jonathan has talked about. So a home has become a 401k for many people that don't have a 401k, and you need to keep that in reserve as much as possible. So just a couple comments on the anchoring thoughts and we face this with Social Security, and they've come a long way before a lot of the information from their office almost biased implicitly toward age 62 early retirement. They've really shifted a lot. You've done great work in public awareness on that. So on some of your materials where you mention age 62, that becomes an anchor number for a lot of folks, but it's not a magic number, but it's a starting line. It's a beginning point of consideration for that option. And whereas people used to think of that same number for early retirement as the starting point for Social Security claiming, we've kind of moved away from that. On page 3 of one of the public documents you have here for consumers, let me just quote this, and I can show this to the staff later. It says, consider alternatives. Wait, if you take out a reverse mortgage when you are too young, you may run out of money. Now that's important. You might want to think about something, if you take out a reverse mortgage when you're first eligible, that kind of slows it down, helps people to consider that. But I think you've done great work here, and we need not nudge people to that starting line of age 62, as Social Security kind of did a few years ago, but has gotten away from that. So I think you have another federal agency to model good behavior for public information.
Lynn?
Thank you so much, and thank you, Hector, for such a comprehensive report, as well as some really eye-opening numbers about how taking out a reverse mortgage when you're 62 can affect your ability to access money much later in life, as well as the amounts of money that you can receive over time. As someone who is already receiving solicitations for reverse mortgages, I can really see when I compare myself to my 70, 80, and 90-year-old clients, as well as my parents who also fall into those categories, how much different my perspective would be on getting a reverse mortgage now than my clients and my parents. And the two things I want to highlight the most, I think, are the responsibility of the borrower to maintain the taxes and the insurance, as well as to keep up with the requirements that the servicers impose relating to the borrower's occupancy of the property. As someone on the younger end of that spectrum, I don't think I would have any problem with paying taxes. I wouldn't have any problem with paying insurance, and I certainly wouldn't have any problem in following the changing players as servicers change, or following the changing rules as they seem to change as the mortgage matures, not because of the terms of the note and mortgage change, but just because the internal rules of the servicers change. And there's two factors in that, particularly with taxes and insurance, because not only are the borrowers aging, but the homes are aging. And I know so many of my clients who come in their 70s and 80s, they're okay with the concept of obtaining insurance, but they can't because their homes are in need of repair. And if there are set-asides with a reverse mortgage, then that just means they're going to get much less at the beginning. So they're either going to get much less, or they're going to have problems in obtaining insurance later in life when maybe they're still conceptually able to do so. Their homes have aged too much. And I think one of my clients highlights the problems with navigating the insurance rules in a very unfortunate way. A 92-year-old client who was literally foreclosed upon because she owed 27 cents in back force-placed insurance sums. And while she tried to write the checks to pay that amount, her eyesight was not so good, and so when she got a letter saying she owed 30 cents, she thought it meant that she owed 3 and sent them a check for 3 cents. And so although it's very sad, that sort of thing is very common. And then shifting to the occupancy issue, I know that I have been telling my parents, and I often hear adult children of my clients telling me that they tell their parents because of identity theft concerns and just, because they're so vulnerable to scams, that if you get a letter from somebody that you don't know, you tear it up, or better even still, shred it. If you get a call from someone you don't know, don't answer it or don't continue it. And certainly don't ever open the door to someone that you don't know. And we are finding that the occupancy rules that seem to continue to change and are not set out in the note and mortgage require elderly people to sign postcards and return them, to sign letters and return them. And this is after they've been told by their children to ignore all of this stuff. And so the very thing that we are doing to try to protect our adult parents is the thing that is going to get them kicked out of their home if they don't return letters or postcards. And I couldn't tell my parents to pay attention and look out for those things, because if I looked at the note and mortgage, I wouldn't see that written anywhere in the documents. So I just cannot thank you enough for the educational efforts and all of your very difficult research on this. I think as that being in that demographic, I think 62 years old is way too young to be making decisions that are going to affect me when I'm 70 and 80 and 90. Thank you.
Sylvia and then Lisa.
Thank you, Ann. And thank you, Hector. As we know, Florida is a haven for the elderly, and the elderly population is really the most vulnerable. We had a similar case to what Lynn was talking about in our agency, where this elderly lady, she was a widow, her roof needed to be replaced, and there was no money. She had no money to do the repairs. She ended up in foreclosure. Luckily, we were able to get the house sold for her before the foreclosure happened, but we see these types of things all the time. And one of the things that I'm concerned about is the commercials, and that was mentioned earlier. And they use celebrities that tend to be someone that the elderly can relate to. And some of the commercials even say you can take advantage of a government benefit. I'm just wondering if there's any way that, and I do know that counseling is required before you get one of these loans, but they're extremely difficult to understand. That being said, the same way that there are disclaimers on cigarettes, there should be a disclaimer somewhere that these people sign so that they really understand what they're, the harm that could come to them. I don't know if that's even a possibility at this point.
One of the ideas of the discussion guide was precisely to serve as that document that the consumer consumes prior to that conversation with the housing counselor. The video and the discussion guide are both precisely informed by our findings in that reverse mortgage ad study. Like, that's how why you saw the big emphasis. It's not a government benefit, it's a loan. You can lose your home. So those were things that people didn't get. They were totally confused when they saw the ads. We had enforcement actions on reverse mortgage advertisement, and we also, the study itself got the attention of the industry, but we benefit from precisely forums like this if you continue seeing those activities and areas in which consumers continue to be confused by those TV ads to provide us, and we will certainly work on that area of consumer education. But the guide precisely was informed by those findings.
Thank you for this work. Super important. I have two quick questions. One is whether you looked at the characteristics of people for whom this would be a good choice, obviously a small group, but is there a set of characteristics in common so that, to help people make these decisions? And the second is just to ask about your dissemination plan, how you plan to get this information out to consumers and whether you're working through agencies, et cetera.
Thank you. And the idea was we have a team in our office that works precisely in the area of engagement and outreach, and so they are working precisely with HUD, with counselors, which is certainly one of those places where consumers will certainly be able to benefit from those. But also we're working with other nonprofits that have been in this space for a long time, like National Council on Aging, and those are very important, again, sort of venues to distribute this. We, in terms of examining other scenarios, our take on precisely all of the assumptions that we use is that, as you could see, there are certain assumptions that are key to changing the trade-offs. So for instance, if someone's, whether it is life expectancy, if someone is able to know that their life expectancy is 95, I would like to meet that person. But more importantly, it will be great, again, if the planning horizon is age 95, you want to plan for that age, regardless of how you feel. That, for instance, is a scenario that increases the benefit out of your lifetime Social Security benefit, and therefore the possibility of assuming that loan up to a higher age. But again, what our strategy here was to raise the visibility of this topic among the professionals who are providing this type of advice, and it was very noted not only in the comment sections in blogs from NormLaw and other similar venues, where reverse mortgage brokers and financial planners were discussing situations in which, for instance, they will say to a consumer, don't even think of this, or you may be a candidate, but you should be willing to know that you're going to stay in your home until death. And that's, for instance, one of those things where everyone was saying you should know that that's where you're going to be, either because you have children that are going to stay there anyways, or there's other variables that contribute to being willing to take those risks.
So I think, Lisa, you put your finger on something that's relevant here, and it's also a general phenomenon across consumer finance markets, which is the financial strategy here is a quite plausible one. If you can delay claiming Social Security benefits, you're going to actually get more money per month when you eventually do claim, although you'll have that more money per month over a shorter period of time. So that's a judgment that people have to make, and we've done a lot of work and offered a lot of insight working with the Social Security Administration around that choice. Many people don't even realize they have that choice to make. They just assume that they're eligible at an age, that's when they're supposed to claim, and they don't recognize that they have things that they need to weigh. The trouble with a plausible claim like this, and that a reverse mortgage could fill the gap and allow you to claim later, is that it'll be true for some people, but it will not be true for others. But all of that nuance gets lost in the marketing. People want to market a product, and they will market it very aggressively, and all the nuance falls out in the marketing, and suddenly they're presenting it as though for everyone this makes a great deal of sense. And what we're trying to do with this report is fight back into the discussion and the debate and point out that there is nuance here, and it will work for some and not for others. There's more that needs to be considered than just assuming that a plausible surface strategy works in the same way for everybody. But again, the incentives people have to sell a product means that they will cut corners and not present it to people in a way that's really congruent to their circumstances, and that's a battle we fight across the spectrum with lots of different products. I think one of our early reports that Gail's group did in the Office of Financial Education was demonstrating that the amount of money spent on marketing financial products to American consumers was, what was the number, Gail? 25 times the amount of all of the aggregate, even plausible scenarios of amount spent on educating those consumers?
Yeah, it was 25 to 1.
Yeah. So that's part of the problem, is big, loud megaphone selling, and very small, still voice saying, hey, think more carefully and understand that there's nuance here that you need to think through.
Judy, then Neil, and Kathleen.
So I agree with all of the problems that people have brought up, and I wanted to go in just a slightly different direction. I think we recognize that a lot of this has to do with the fact that people are trying to figure out how to survive retirement and feeling that Social Security isn't going to be enough to do that. And so there's all these different strategies. And I'm thinking in terms of the dissemination. I think that's something Lisa was talking about. I was recently invited to an event in Chicago with the SEC. And you may already be aware of this big effort, but they are finding real problems with small dollar investors who are doing the same kind of thing, right? They're trying to figure out how to supplement their income and getting involved in lots of scams with small investments, a couple thousand here and there, which is kind of the population that this is appealed to. And I know that they've set out an effort to go around the country and especially really thinking about going into churches because they find affinity fraud is a big area. And it just strikes me that some of these materials coupled with what they're talking about would be useful. So I don't know if you partner with them or just inform them to have these things along, because I think if you could reach that audience when they're thinking about these things at 59, 60, 61, it might be useful to, give people a fuller picture. I think there's like Lynn, now that my husband and I are reaching this age, the daily barrage of mail coming in, and you start to notice all the commercials. And I think that people don't really get time to sit down and think it through, and perhaps getting that information a little bit earlier where they can digest it would be useful. And I think that might be one place you could get involved.
So I think you lay out a very clear case that it's a bad financial trade to bridge, this with a reverse mortgage. But though having personal experience with some family members who kind of, in the debate, the response is, but I need the money now. So it is effectively a transaction that, and I think building on some of the things that Brent mentioned, it's kind of too late to get into that debate if that's the mindset of the people that are involved. So I just wonder if the target audience for the transaction I appreciate and I agree with, but I do think that the long-term target audience are people who are 50 or 55, and that as part of a broader financial plan of education, I think is important. And the other thing that I've been kind of wrestling with now, as a lot of my peers, my age peers, are kind of in this kind of pickle. There isn't a place that a low moderate income person can go for retirement planning that I think is efficient and effective. And I wonder if the Bureau has kind of thought about that as a place to look, because I think that it also then has a relationship to some of the products and services that people need. So a retired person needs to think about an investment strategy, an income or cash flow strategy, a asset protection strategy, and all of that stuff that people have mentioned. And I just wonder where you might be in terms of your thinking about that.
You're absolutely right that this is a decision that is hard to make at the moment when you wish you had made it 10 years sooner. So you've given us a lot to think about. There's more work to do, but one thing we have done is the time of retirement tool. Target audience for that is 50 and up. The idea is start thinking when you're 50, what age do I need this income? Because that's a time when people, if their physical health allows it, can still choose to work a little longer, to think about where they want to live in retirement, to make those kinds of budgeting trade-offs at a moment when you can still change your income if you're able to work and you're still employed. And you're right, people need to think about that earlier. So the time of retirement tool target audience, in fact, is people who are still actively working and daydreaming about retirement, so that daydream becomes a little more grounded in some of the financial realities. We have done some cooperative work with the SEC, and we'll certainly look into what else they're doing. We did a piece on the difference between a real investment advisor and a fake senior expert with a 4-hour course behind their name. So we'll look at what else can be done, but there's more to think about here, certainly.
And I think Neil's point, which is a good one and quite suited to the Office of Financial Empowerment, is that people of modest means do not become good candidates for anybody to give them financial advice about retirement. If they have greater means, then they're more attractive customers to financial planners. But the great mass of Americans, many of whom need this advice the most, it's not going to be, financially sound for somebody to offer it to them for profit. So we're going to need to figure out ways, and perhaps this Bureau, to fill that gap. So.
Kathleen?
Thank you, Gail and Hector, for another great project and important report. As I've been listening to the discussion and thinking about the discussions we had about payday lending yesterday, and overdraft, I'm aware that one of the challenges for the CFPB is that you all are working really hard to solve a huge problem of economic inequality that's grown since the 1950s, and that's a really tough one, and Neil's point goes to that. I have a couple of points. One is that on the form itself and the important questions, one of the questions is, do I plan to remain in my home for a long time? And as we know, most people are excessively optimistic, and lots of people do plan. It doesn't mean that they believe they'll be able to, and I'm wondering if you could think about that wording a little bit, maybe even if there's a statistic out there that says, the average age at which somebody is able to live independently is X, so that people realize that. And again, these are comments on what I think is great, so I don't want it, I don't want you to think I'm overly critical of it. Under the alternatives, I think I would take moving to a more affordable home as its own option, bolded. And I also think it could be good to say something about talking with family. Like Neil, I've had a number of family members who come to me for advice about reverse mortgages. They don't listen to me, but they do come for advice. And one of the things that I've learned is that a lot of older people think the children will be devastated if they sell the home. I can't do this to the kids. And to say, talk to your children, because oftentimes the children want them to sell the home and move to a place that they can manage in terms of size and maintenance. If there's a way to talk a little bit more in here about the single disbursement, and I know that you really try not to have cluttered documents, the single disbursement is a huge problem. And it's, we know what the risks are, but to be thinking about issues of parental abuse. So I know of a situation where a family the parents did a lump sum payment because their child was managing their money and said it was the right thing to do, and they haven't heard from the child since. So these kinds of things can happen. And to maybe, I know that you don't like to put in a lot of recommendations, but I think that this product is one where recommendations could be really valuable. To have it just as a document about these are your options, I don't think is enough. So for example, having a recommendation that says if you're going to do a lump sum disbursement, you should have a tax interest-bearing escrow account where your projected taxes and maintenance fees and insurance are escrowed, so you will have that money. And that's it. Thank you very much.
Seema and then Chi-Chi.
Thank you. So just quickly, somewhat related to what was just said, I think this information is really great and very important to get out there. I think what we learned from the foreclosure crisis is that a lot of homeowners don't understand the basic concepts of equity versus the actual property itself. And so I think, thinking about generational wealth, my organization is thinking about this a lot, about how families really approach wealth building in an intergenerational way. And I think emphasizing the point that taking one of these mortgages might impact their ability to leave wealth for their next generation is probably an important point to emphasize. I know when we worked with a lot of homeowners, that was the deciding factor for them. So it might prompt more homeowners to sell the home or take another direction if they understand that that's really what's going to impact their long-term ability. So, thank you.
So I wanted to pass along some thoughts on reverse mortgages from my colleagues at NCLC because, as I always say publicly, I know nothing about mortgages. So one of my colleagues reports that, despite the focus on counseling as a form of consumer protection. There's some weaknesses in the counseling process. One thing is that the counselors don't actually have the client's loan documents, so on hand at the session, so they can provide a general analysis of the client's financial situation and reverse mortgages in general, but they can't really determine whether the particular product is the right choice. And the focus is on the mechanics of the reverse mortgage and the comparisons, but they don't address broader financial, legal, and estate planning consequences. And then in terms of the origination documents, they're unlikely to show how expensive the monthly servicing fees are, but they should. And then servicing itself is a mess. They've heard a lot of stories like the ones expressed today, and in fact, instead of me taking a lot of time to go through them, they've compiled a document discussing a whole bunch of examples of servicing abuses, which I believe will be circulated later. I cannot take any credit for this. It's my colleagues at National Consumer Law Center, plus Lynn actually put a lot of time and work into that document, and a lot of the examples are from her clients. I just want to let the folks know that'll be coming along.
Patty?
You know, I kind of wanted to put this a little bit from a lender's perspective on oversight. You know, in 2016, there were approximately 46,000 reverse mortgages done. And 80% of that business was controlled by 10 originators. 10. So it seems to me that maybe we need to just put, you know, really clear oversight guidelines around the top 10 originators and let them know that there will be numerous visits on quality and overall delivery of the product. I mean, I'm a believer of the product. I deliver the product. But my team mirrors the communities we serve. So is that happening? So I think stricter oversight, the fact that they know that we're going to be in their offices and that it's clear exactly what we're looking for from origination to servicing. Who's servicing them? Are they overseeing the servicer? How are consumers being treated post-closing is really important.
Thank you so much, Hector and CAB members, for an enlightening conversation. So we're now going to switch topics and turn to Yannicka Ratcliffe, who's the Assistant Director of Financial Education, and she's going to share with us some new research about financial well-being.
Okay, thank you, Anne, and members of the CAB. It is really exciting to be here today to present to you the latest installment in one of our major initiatives on regarding financial education for adults, our work on financial well-being. I also want to acknowledge that our Office of Financial Education partners with the Office of Older Americans in this work, and we also have Hector here, who is one of the co-leads on that project. So I will do a lot of the slides, and Hector will answer all the difficult questions. Just to note that this presentation is being made by a Consumer Financial Protection Bureau representative on behalf of the Bureau. It does not constitute legal interpretation, guidance, or advice of the CFPB. Okay, so to put us in context, we have, as you know, an essential part of the Bureau's mission is to empower consumers to take control of their financial lives. And while certainly that requires a safe and transparent marketplace, consumers also need to be able to navigate that marketplace to achieve their own financial and life goals. We have regularly engaged with the CAB in discussions about consumer financial education and financial well-being, and your insights have shaped each subsequent phase of the work. So I'm sure today will be no exception. I'm really excited to get your feedback. I may end up talking really fast to get through the material so that you all have time to do that. Sorry, I want to position this work in the total arc so far of our financial well-being work. As the director mentioned, we started in 2015 with a definition of financial well-being. This was motivated by the fact that across a range of different financial education and financial capability programs trying to accomplish all sorts of different specific things, and even across different countries, there was a consensus that ultimately everyone was trying to improve people's financial well-being. What there wasn't was any kind of clear definition of what that really meant. So we set out to do that in consumers' own terms so that we had a definition that would resonate with them. It basically boiled down to four things: having control over your day-to-day money management, having the capacity to absorb a potential financial shock, having the financial freedom in the current moment to make spending decisions to support your quality of life, and then as you look forward into the future, feeling a sense of being on track to meet your long-term goals. This basically boiled down to a sense of financial security and freedom of choice in the current moment and when looking out to the future. So that's a nice, tidy definition, but what else is clear is that what that means to me and what that might mean to any one of you in this room could be very different in a tangible way. So the next question we tackled was how to measure financial well-being. So using state-of-the-art methods, and we developed, tested, and validated this financial well-being scale in 2016. There's 10 questions here. They can be quickly answered by any consumer, and they don't require a lot of going back to your files to figure your numbers out. What this scale gives you then is a single score on a scale of 0 to 100 that's robust and can be used by practitioners and by researchers to make comparisons, apples to apples comparisons across different programs to gauge what's effective, across different people to figure out who is benefiting, and across time to gauge progress. And that brings us to where we are today. The question, what is the state of financial well-being in America? And as you will also see, we're beginning to move into the area of what helps people have more of it. So we use the scale and a nationally representative sample to collect the information about the state of financial well-being. And if you want to know all about the methodology, you can refer to Appendix C of the report or talk to Hector as well. Before we get into the headlines, I want to say that the research we had done before suggests that financial well-being is determined by an interaction of a lot of different factors. Absolutely core to financial well-being is your social and economic environment. Do you have access to opportunities, to jobs, to benefits, to sufficient income, family resources? All these will be fundamental to your financial well-being, as may be access to financial products and services. So I want to start by recognizing these structural factors that may well be out of the control of an individual and certainly outside the control of what financial educators can influence. But what we are also interested in particular is to understand, as financial educators, what knowledge and skills and attitudes and beliefs and motivations can also play into financial well-being. To put all these pieces together, we collected over 70 different measures that suggested to us what might be important in determining financial well-being based on our research before, keeping in mind that some of these factors are fixed, some are malleable, some are within a person's control, and some are not. So we will get right to the results. The average financial well-being score for U.S. adults is 54, so that is right there in the middle of the 0 to 100 scale, and you can see that there is a normal distribution, but a relatively wide one. About a third of adults in the U.S. have financial well-being scores of 50 and below, and about a third have scores in that 51 to 60 range right there in that middle green bar, and then about a third have scores of 61 and above. So I want to emphasize one of the key findings today is that financial well-being scores really do reflect real differences in underlying concrete financial circumstances. Those who scored 40 and below almost all have financial insecurity, and those who score above 70 are almost all likely to have to be basically financial secure in a basic sense. So I'll give you a little more information behind that. This shows what percentage of people in each score bucket, with the lowest score buckets being at the top of the slide, had difficulty making ends meet. Overall, 43% of the respondents in our survey reported struggling to pay bills in a typical month. So that in itself is a pretty powerful statistic, as the director had mentioned. When you look at it by financial well-being score band, more than 9 of 10 individuals with financial well-being scores between 11 and 40 reported having difficulty making ends meet. And then when you go to scores above 60, it falls to less than 1 in 10. And you see a similar, build slides, sorry. There you have it. You see a similar kind of breakout for experiencing material hardship. About a third, or 34% of all the consumers we surveyed, reported experiencing some form of material hardship in the past year. So that is just over a third who reported running out of food or worrying about running out of food, not being able to afford a place to live, or medical treatment, or having their utilities turned off. And again, you see these stark breakouts by the lower financial well-being score bands compared to the middle and then the upper score bands. Okay, so the next thing, now that we've sort of had a quick look at the state of financial well-being in America, is to try to get into the crux of the matter, which is what can help people have more of it, and to explore that. We want to look at what factors are associated with having higher or lower financial well-being. So we're going to look at comparisons of financial well-being for selected subgroups by the characteristics we collected. These descriptive findings provide insight into which subgroups are faring pretty well financially and which ones are facing greater financial challenges. And so all the differences I'm about to present to you are statistically significant. However, it is critical to bear in mind that they are descriptive in nature. So any kind of relationship between a characteristic and financial well-being score does not mean there's a causal relationship. Any characteristic could be related to financial well-being for a number of reasons. Of course, possibly that factor could drive financial well-being, and it's also possible that the reverse is true, that financial well-being drives that factor. And finally, it's possible there may be underlying factors that are correlated both with financial well-being and that characteristic. So please keep in mind when we compare the financial well-being of two subgroups, we are not attempting to establish the cause or driver of financial well-being at this point. Only through further research and controls for multiple factors will we be able to tease out those relationships, and we'll be looking forward to your thoughts about what those could be. Okay, so the second major takeaway I wanted to emphasize is that financial well-being scores also capture information beyond traditional financial measures. So, for example, as you'll see, at all income levels, financial well-being scores vary widely, so that you could have somebody in a lower income group that has a financial well-being score higher than many people in a higher income group. So that income is clearly not the full story. These wide and overlapping distributions suggest that even when an individual is a member of a group that is at a relative disadvantage, there could be, and we hope to sort out what those are, compensating factors or strategies that can offer opportunities to improve financial well-being. And again, future analysis can lead to better understanding of how all these various factors interact to determine financial well-being. So let's look at some of the characteristics, and I'm sorry for the smallness of the slide, but this also, I'll try to give some words to help us interpret this. First, we're looking here at the individual characteristics that we looked at, that we examined. Education, age, physical health, race, ethnicity, and sex. And I'll talk a little bit about how to read this. The graphic that you'll see throughout the report, it shows you that the average score is 54 for all consumers, and then it breaks it down by different education categories, so that those with less than a high school degree have an average score of 48, whereas those with a graduate or professional degree have an average score of 61. So you can see graphically how far those differ from the average. And you can also look at this and quickly see that financial well-being, on average, increases with education. It also, if you look at the age bucket, on average, increases with age and is better for people with excellent or good health versus those who have just good to poor health. And then perhaps somewhat surprisingly, at this descriptive level, race and ethnicity did not have quite as strong an association with average scores. And in the case of sex, it actually appears to be neutral. So I wanted to stop there and use this as a way to sound an example of caution interpreting the results. In our sample, as in the general population, the average age of the female group is pulled higher due to longevity. You can also see from this picture that the old age is generally associated with improved financial well-being. So it may be very well possible that when you control for age, you will see that women have lower financial well-being than men, which is consistent with some of the research. All right, and then let's look a little more closely at the educational factor and also a graphic that you will see consistently in the report, so we'll talk about how to look at that. The longest distance you'll see for any subgroup, the light gray bar, covers the distance between the 10th percentile and the 90th percentile. And then the dark gray in the middle shows you the 25th to the 75th percentile, so half of the respondents will have been in that dark gray area, and then the average is shown by the number. So here again, you can see that it goes up with age, but that there's wide distribution, so that despite the big gap between, say, people with a graduate degree and people with less than a high school degree, about half of those with less than high school education have similar financial well-being scores to those with professional degrees. So again, while it's correlated, it's clearly not the whole story. Similarly, we see average financial well-being increasing with age. That could be explained by many factors. It could be increased asset accumulation, increased income, access to Social Security. It could also be due to differences in expectations and goals and priorities at different life stages that could affect subjective financial well-being. And I also want to invite Hector to talk about some of the things that this age distribution might indicate.
Just want to say that precisely because this is a cross-sectional sample, we don't know necessarily that the path of an individual over their life course in terms of their financial well-being. But as you can see, one thing that caught our office attention is that as you look at the different age groups, the distance between the 10th and the 90th percentile remains relatively the same. And in fact, it's hard tell here, but it actually increases a little bit with age. And then there's also that small decrease in later ages. So we do have an oversample for this population. And part of our research agenda is to explore in more detail those nuances.
Thank you. All right, so next we'll look at some of the household and family characteristics, specifically housing satisfaction and housing status. We also, in the report, you can look at marital status, children, and region, and by region there was actually no difference in average financial well-being scores. So here what we see is that adults who report they are very satisfied with the place they live currently have markedly higher average financial well-being than for those who report being less than very satisfied, and homeowners have an average financial well-being higher than both renters and those who neither rent nor own. On a related point, not on the slide, adults who spend 50% of their income or more on housing have an average financial well-being score of 46 compared to 56 for those who spend 30% or less of their income on housing. So these findings do not necessarily mean that good and affordable housing causes financial well-being, but I think this is an area that really calls for further analysis about the relationship between housing and financial well-being. Next, we'll look at some of the income and employment characteristics. Again, I urge you to see the report for more detail, but I'm going to go straight to the income breakout because, again, this is another key important takeaway. Yes, as may be expected, individuals with higher income have on average higher levels of financial well-being. However, the distributions for income groups are wide and overlap substantially with one another, suggesting that factors other than income are at play. Certainly, it will be really interesting to tease out what other factors matter. For example, where is it that you find low-income households with high financial well-being or high-income households with low financial well-being? And then I want to move into one of the most interesting and another key point I want to drive home is the apparent importance of savings and safety nets. Of all the categories we examined, the biggest gap and the least amount of variation within groups occurred for liquid savings and the ability to absorb an unexpected expense. So here you see financial well-being score by liquid savings. On average, adults with greater savings have higher financial well-being. Those with $250 in liquid savings or less have an average financial well-being score of 41 compared to 68 for those with $75,000 or more in savings. So this is a 26-point difference and is the largest difference observed across any factor examined in this report. Again, you should note here that the overlap within subgroups is relatively small compared to some of the other factors. That is, within each subgroup, the financial well-being scores cluster more tightly around the average, and there's very little overlap in the distribution of scores for adults who have the very lowest and the very highest level. And you sort of see a similar story when you look at the capacity to absorb an unexpected expense. That is, could you come up with $2,000 in 30 days? There's very few individuals who are certain that they could come up with $2,000 are in the lowest financial well-being ranges, and few who are certain that they could not come up with that kind of money are able to report high financial well-being. So these differences suggest that financial cushions may be more closely tied to financial well-being. Certainly that piece about security is key here than income. Next, we'll take a quick look at some financial experiences. Again, I urge you to see the report for more details. But here, the largest differences are based on whether an individual has been turned down for credit, contacted by a debt collector, and the use of certain financial products. These two negative financial experiences, being turned down for credit or contacted by a debt collector, are more common certainly among individuals who are experiencing economic stability or facing serious constraints. So again, the relationship between these experiences and financial well-being may very well be the result of underlying financial vulnerabilities. However, it's possible as well that having one of these experiences could affect your sense of financial well-being, or some of both. It may be a bit of a cycle. Again, more to be learned. Adults who do not have a checking or savings account, who reported using non-bank short-term credit over the prior 12 months, and who report using non-bank transaction products, all have lower financial well-being than their counterparts. Again, I don't want to say that this is necessarily causal. Finally, what financial educators and financial capability builders want to know is what is the role of things like financial behaviors and skills and attitudes. What stood out was confidence in one's ability to achieve a financial goal, which we often refer to as financial self-efficacy, having a habit of savings, and effective day-to-day money management behaviors, as well as financial knowledge and skill. Take a look at those. Consumers with high levels of financial self-efficacy have an average financial well-being score of 63, compared to those with lower confidence levels and an average score of 50. Adults who made a habit of saving money, and that's really not surprising given the findings we had on savings themselves, and adults who engage in a high number of effective money management behaviors have higher financial well-being than their counterparts. Keep in mind that several of these practices, for example, paying your bills on time or paying off your credit card balances in full each month, of course, are dependent on having enough money to do so. So again, the correlations might at least in part reflect on how simply having sufficient financial resources leads to both better money management and higher financial well-being. And we see that adults with higher levels of financial knowledge have a higher average financial well-being. That's 58 compared to 51 for adults with lower levels of financial knowledge. It's important, I want to point out that there is a really high level of overlap in these different subgroups, suggesting that this factor alone does not explain a lot. There is a larger difference in average financial well-being scores for adults with higher versus lower levels of financial skills. And in this case, the overlap between distributions is low, suggesting that the skill relationship with financial well-being may be stronger than the knowledge relationship. And this is consistent with what we heard when we talked to consumers and asked them what knowledge was helpful to them in their financial well-being, and they were much more likely to mention knowing how to do certain things than specific financial knowledge and content. And the things they said they wanted to know how to, that were helpful, the skills, were knowing how to do your homework and your shopping and gather information, how to understand that information and analyze it and use it to make a decision, and then how to actually implement that decision and stick with it. And then the nice thing about skills, and that's what we tested for, but the nice thing about skills, of course, is that they're transferable across different financial transactions. So I want to go talk briefly about what this means for opportunities to improve financial well-being for financial education and financial capability programs. First, takeaway might be that based on just what we can tell, what these findings point to is that a lot of programs seem to be on the right track. Certainly with respect to programs that seek to build savings and safety nets, that seems to be responding to something we saw here, as well as how experiences with debt and credit seem to be strongly associated with financial well-being. And then, the good news is there seem to be positive relationships with attitudes, behaviors, skills, and knowledge that is the domain of financial education. There is, good news, a growing body of evidence about effective ways to move the needle on these things. Our recent release of Effective Financial Education, 5 Principles and How to Use Them, which we shared with the CAB before the release of that paper, documents the evidence of many of these strategies working, and we hope that that will encourage innovation in program design and delivery and as always, further research. Okay, so that it was the summary of the findings, of highlights of the findings anyway. And I did want to mention that there are more things that we released with this. Simultaneously, we released the data set behind this. 217 variables, including the financial well-being scale and all the characteristics that we reviewed here. We hope that researchers and policymakers and practitioners and any one of you in this room can use this data set to explore some of these relationships as well, so that we can all help move individuals along the pathway to greater financial well-being. And then we also released, as members of the CAB had suggested to us when we first shared with you about the scale, we have released an interactive tool for consumers to find out their own financial well-being score, so that they can go online, they can answer the 10 questions, they can get their score, and then they will be pointed to resources that can help them improve their financial well-being depending on what their particular interests are. So here we are. Today we're asking the CAB to help us plot the way forward with all this rich data and your insights. Specific questions that we would like your feedback on include, first of all, if you have any questions that we can answer, that Hector can answer, which of the survey findings really resonate with you, and maybe what were new insights for you, what this triggers in terms of ideas for research questions that can be explored with this data, how the findings and data and consumer tool can be useful to you in your work, and what you would suggest for the CFPB to put to work the findings and the tool going forward. And thank you.
Thank you so much, Janneke. That's so much amazing information. So lots to think about. And so I'm going to open it up for discussion. And Patty, would you like to lead us off? Oh, I thought you did. Oh, wait.
Thank you very much for the research. Very, very interesting and helpful. Maybe I misunderstood what was said, but I was a little bit surprised to see that region and community seem to not influence the self-perception of financial well-being. There's some research that points that perception of well-being is relative to the community that you live in. What are your thoughts there?
Janneke, do you want to answer that? So we use census region, and they're pretty big. And so you have, diversity of communities there, and that basically wipes out those nuances. But there is the housing satisfaction question, and there are other variables in this survey about the community has services. There's job opportunities, and those all have strong relationships with financial well-being, and I'm happy to provide you the more specific details. But those results are in the appendix to the actual average score, as well as how the answers were distributed.
Ruhi?
So yeah, mine would be a follow-up as well, and we can talk offline. If you broke out from majority non-white census tracts and how that played out, and housing values have changed and not changed, and risen and not risen. Even if you look 50 years or 20 or even the last 10 years, how wealth has come back or not come back changes within communities of color and as opposed to white communities. My thought, my sort of comment on this, this is amazing because Rochester has the highest child poverty for one of the top 100 metropolitan statistical areas in the country, and I think we're fourth for adult poverty. And we have it's called a poverty initiative, and we're looking at a whole bunch of these factors and playing things in. And I was talking to Dr. Slaughter when I first started doing access to credit work in the early 90s. We could take someone making $25,000 a year, a single mom, and turn her into a homeowner. We could put her into IDAs, individual development accounts, with savings of hers, with help, and we could get her out of expensive, not good housing, rental housing, into good home ownership, which did build some equity, and again, that varied depending on where you bought and how the subprime crisis played out for you. Now, when I take someone at $25,000, and I'm actually going to be working on a report on this in early 2018, I've got to figure out, I need to have that person have financial capability training so that when she gets into a checking account, she's not ending up in overdraft fees, or that when she buys that first used car to go to get a job and keep her job because public transportation doesn't work for her, that she's not being set up to essentially fail for probably an indefinite period of time when she's ending up with that. So this is really, very helpful work. And so the main policy thing that I'm getting out of this is that not having that safety net, because it's that emergency where you end up having done absolutely everything right. I mean, and that's what's, in the old days we were like, hey, you're making $25,000 a year. We can show you how to pay your bills so you build assets. Now you're making $25,000 a year, and you can do absolutely everything right, and you still can't make your bills, and that's just heartbreaking. You can have 2 or 3 jobs, and you're doing absolutely everything right, and you're still falling behind. And how do we turn that income inequality, short of all of us becoming wage justice attorneys, which I have considered doing, and but you cannot, if you're low or moderate income, we have to make illegal bad abusive products. You cannot educate someone who has no choices and who has their back against a wall to not make, which, and so that's where I think, this is a really important role that we play. There's a lot of work to continue to be done. I mean, I'm grateful for the payday rule, and now I need to understand, okay, you're not going to get a bad loan anymore. Hey, financial institution, hey, bank, how am I going to make sure that you give a good loan out that's affordable and that can be paid over a period of time, and that's building assets and credit. So that, to me, that safety net, that's a huge, I mean, I've been saying things for 10 or 15 years, but now I have data that backs up what I think I know from talking to my clients. So thank you.
Thanks, Ruhi. And I'll jump in just a quick, one of the things that struck me, and it sort of goes a little counter to Ruhi's comment, which perhaps could be that tighter regional impact, is that your data doesn't show income as being the defining factor. And one thought, we did a study in Texas on an affordable small dollar loan program that was accessible through the workplace, and really anybody, no matter their credit score, could access the program. And what we found in people's perception of the impact of the loan on their financial well-being was, over a 1-year period of time, they weren't able to build savings but were able to reduce debt, which we thought was a pretty powerful finding given the short time period of the impact. And it might be interesting as a next study point to look at what kinds of financial products have measurable impacts on people's financial well-being, so that what will do beneficial are products that don't have some of the pitfalls that we've talked about in these conversations. How do they move people forward, and what are those products that are most powerful in doing that? Now, Brent, and then Sylvia.
And I think Dr. Howard, too. Yeah. I think this is a great study. I took the test, and I scored myself down by misreading a question, so I retook it. But I'm going to introduce a concept just based on a lot of things that a lot of us know about U.S. financial diaries, volatility, the inability to smooth income and expenses throughout a year, even a few months through a summer or holiday season. And what we found as Americans have moved to this idea of a 2-income family or 2-income earners in a setting. So I just want to introduce, I'm going to use a musical analogy. You have that progress bar that looks like a little barometer or thermostat. I'm going to suggest something called the Beatles barometer, and that's I get by financially with a little help from my friends. So I don't know how this can be done, but this idea of income pooling and pooling of paying expenses, could be multi-generational, has a lot of different ethnic groups do pool money more as a community, and but people sometimes need to work with others to get by. And if there is a way to have a supplement to this tool or something standing alongside that allows people to input as a couple or 3 or 4 people. HUD or Fannie Mae, I think, even made some changes to mortgage eligibility to allow income from boarders in a home and even somebody living outside a home. Some of that money can be counted as eligibility. So this is the new dynamic, I think, in America. It's probably an old dynamic of how people have gotten by. And it also applies to the aging issues we just talked about earlier, because then you have a death in a family, a 2-income Social Security check becomes 1. So you actually have a drop, and co-senior housing is another issue too. So I just want you to think about, helping people get by with the help from their friends and family.
I'm not sure who's going to answer this question, whether it's Hector or Yannicka, but we recently incorporated the tool into all of our housing, education, and counseling and financial literacy classes. So we'll be able to report back once someone gets through the different programs. My question is more for clarification. In the research that was done, was the fact that those who had college degrees or beyond, and obviously they were earning more income, was the education and the income taken into account because of their higher potential the potential to earn higher income? Was that part of it as well?
So in this particular presentation of the statistics, it's really meant to whet people's appetite to get down to those further levels and to sort of do multivariate analysis that would take into account education and income and other factors like that all at once to see how they all play together.
I will say that one value of what you're doing with your clients is that precisely you will be able to look at that longitudinal piece, measuring it multiple times, and that's where you see the effects of, and the issue of earnings potential you have to look at in a survey probably of 30, 40 years in people's lives, but in your case, an intervention that does take time and see how that associates. I really appreciate a lot of the feedback here today, particularly on the idea of the role of family and resources, because the measure, again, what it shows is that it is more than what I used to work a lot on access to Medicaid and food stamps, and I know that income is just one measure of what people are experiencing, and those programs provide significant support, and so I think financial will be maybe capturing all of those contexts, all of those things that the consumer knows that they have, family and others, and that's a more comprehensive measure.
Sylvia mentioned using the scale in his before and after in a program setting, and that's certainly of great value. Thank you for being an early adopter there. I want to highlight 2 other uses. We are aware of a few employers who are using it to both engage and learn about the status of their workforce and what stresses they might be under, and to think about their own workplace financial fitness programs. And you got to know where your workforce is before you can think about what you want to give them. And the other is this potential to use it for local needs assessments, both for local officials and for nonprofits and community foundations who are looking at learning more about the local area.
Brian, Neil, and then Howard.
Thank you, Yannicka. It's a great piece of research. It's great to see how it's progressed, I think, since the last time you spoke about using this tool. And I had 2 questions for you. One is are you considering maybe how this could be used to attract people to the CFPB's content? It's a tremendous amount of great content. It's well written and it's very approachable. And we saw just, the latest piece, I think, from Hector and his team. And it would seem that this could be the entry point, for a lot of that content. You've got to change your batteries in your smoke alarm at daylight savings time, and we all know we got to get a flu shot in the fall. So it would be, you got to lose weight come the first of the year. It would be great to see. It would be great to see, something around. Okay, it's the first of the year. In addition to losing weight, it's time for me to measure my financial well-being and the resources the CFPB put to bear. So I'm kind of wondering what consideration is given to making this the gateway to the content. And the second thing is, I'm wondering, On the back end of it, is there any thought given to now how to make it a prescriptive next step? And I saw you had links and research, and they say now if you want to, but if you take it and you say, okay, your score is 54, here's some reasons why, and then maybe a more explicit channeling into the next step of what do you need to do next? Well, I need to get a budget, or I need to get a checking account, sort of depending on the circumstances, if you'd given any thought to kind of the next steps, or guiding them to resources in their area, many of which are around this table, and kind of pointing that out. So just kind of wondering what's next.
So thank you. Those are all great ideas, and I think you're painting a picture that's consistent with our vision, and I really like some of the tactical ideas about how to get us there. So we'll we'll be tracking. This thing just came out recently, so we'll be tracking the kind of the hits and what people do from there, and then looking for ways to improve it. And I really appreciate that feedback and those ideas. Thanks.
I would just add that this is probably a perfect thing to do with our families and during Thanksgiving. It's one of those challenges, like what is your financial, we have done it with elder financial exploitation. I think this will be a very fun one to definitely do.
I think that one of the insights here that I appreciate is the potential distinction between cash flow and income, and I think Rui mentioned that would be a place to kind of dig deeper and understand more about like what was under that, and so people could actually then benefit from it. I'm also encouraged that your audience from last time we were here, which was kind of the consumer, has been broadened out to include employers and potentially community groups and all that. I wonder, given the Wells Fargo scandal, okay, I think that one of the things that I know that banks and financial institutions are laboring with now is that sales is considered to be a bad thing, right? Okay, and could a potential audience for a dialogue here for banks or other financial institutions be financial well-being as a platform to actually think about a selling or even a sales management strategy that could be woven into incentive plans and other ways to kind of manage that effort to the benefit of the customers and the financial institutions' shareholders. The other place that I wonder about in terms of the audience, are you using these insights as they evolve to inform the Bureau's approach to operationalizing rulemaking, priorities around overdrafts and stuff? So yesterday in the closed session, we talked a little bit about overdraft research and stuff like that. There's a piece here that I think has some gold in it that might actually drive some of the priorities you might have in terms of influencing overdraft users in those cluster groups.
I think the point you made, Neil, just now about is it possible that banks could be pushed, nudged, or themselves decide to go in the direction of starting to take their bearings, not just by what they sell to their customers, but by whether the overall set of services they're providing to their customers over time is raising their customers' overall financial well-being? That's extremely interesting. And I don't know what would get us from here to there, but it would be a very different mindset, and it would be a very beneficial mindset, it seems to me. And there are a lot of community banks and credit unions who talk in these terms, and I think actually consciously try to think in these terms. But whether we could adapt the measure and have that be a way to actually have people be thinking around how do they do this with their customers, that's kind of interesting and promising.
Yeah, the interesting thing to me is that financial well-being research has been around for a while, and a good deal of larger financial institutions have access to research like this that could potentially inform their strategies. I think that as you begin to try to influence kind of behaviors in this realm, it would be good to perhaps remind people that this could be an approach that could be effective.
Howard?
Thank you. Just a few comments. First of all, I think the work that CFPB is doing in this area is very, very excellent. we at Habitat for Humanity of Greater Pittsburgh and around the country work with many of the most vulnerable populations in America with regards to financial wellness. One of the key things that we have found that there is no standard definition of what financial well-being is. So for one sector, it's one set of definitions, and for another, it's different. So I think some additional clarity around or some ideas as to how we can make this term in and of itself uniquely universal would be helpful, because when we talk to consumers about home ownership, some believe that they are financially well, and they are not, given the definitions that we have used. We also realize and recognize that there is a serious disproportionate level of net worth when we look at the different ethnic strategies that we are focused on. African Americans and other populations still are at the lower end of this area, and we have found that there have been many, many challenges in working with these groups. And so I think a way in which we can provide more information to groups that are, in some cases, more vulnerable than others is still certainly very, very important. There was a recent article out that actually stated that there were questions asked of certain consumers, and the question was, could you come up with $400, not $2,000, $400 in an immediate emergency? And the majority of those who were asked could not even come up with $400. So this issue is very, very troubling and something that we have to work on. When I did some research on financial literacy, we did a focus group, and the hypothesis was that if we took young people, because we believe that focusing on this area at the youngest possible age, not meaning kids in grade school, but about to go to college, we did some training with some students at one of the universities in Pittsburgh, and we took students who had no real knowledge of financial information at all. And the hypothesis was that if we trained these students who had no experience and gave them a set of data, information, and took 1 week of training, the hypothesis was that we would definitely see an increase in financial education and awareness. And the hypothesis was proven that that level of information just for a week makes a significant difference for students. So while this is not something that CFPB can do in and of itself, these are some of the ways in which we can push down this financial education to a level that will help those students going to college. We all know, or we should know, that there are many students who are freshmen in universities that have never had any kind of financial literacy training or education. And if that doesn't continue, if that continues to occur, we'll continue to see a dearth of significant financially astute students, and then obviously young adults. The other concern that I think is important is when we talk about working with individuals, we also have to be inclusive of families as well. At Habitat, we work with individuals and we work with families. And I think if we can make some of the information very, very basic so that more people may have an understanding, while all the scores are correct, you have FICO scores, you have a wellness score. If we could make it very basic so people can understand it more effectively, I think that helps. And then to utilize others who have had some success in these areas to help bring about some of the change. I think those are some of the things that would also be very, very helpful for some of the people we are trying to work with and affect positive change. This is very good information. This is a very, very difficult and tough challenge, and I'm glad that CFPB is working on this, and I think there can be some substantive change by making some very, very basic new strategies and agendas for people who are vulnerable in this area.
If I could just jump in, I don't want to take us off course off of the adult financial well-being work, but you mentioned young adults and youth financial education. We use this definition and research on adult financial well-being to sort of back into what are the attitudes, knowledge, skills that adults have that indicates are associated with financial well-being, to then back into what are the building blocks of those things throughout the developmental cycle. So on the youth side, we've created a report on the set of building blocks and the characteristics. They may not even be financial in nature, but the kind of things you want to build in at each age group, and some tools to support that. And so we have some other initiatives on youth financial education, which perhaps we can share with the CAB at a later date.
Judy, Lisa, and then Julie.
So you ended your presentation with a question about things we'd be interested in having you take a deeper dive in, and one of them was the relationship between housing and financial well-being, and that would be of great interest to me, especially in terms of the percentage of payment, percentage of people's income that they're spending on their housing, and if that has any relationship to financial well-being or not, or whether having stable housing has any relationship. I think we all have a gut feeling what the answer is, but it would be very helpful to know that. And then my other two were questions that were really sparked by things other people said. To what extent did you distinguish when you first brought this out, I went through the little test. I don't remember now what exactly all the questions were, but to what extent did you make any distinction between whether the income being reported was two-person or just the individual's income, because that does lead to, questions about if you lost this other income, would your financial well-being stay the same? And then, again, related to something Ann said, to what extent did you look at, if at all, whether people were saving, but also whether they were reducing their debt?
So we do have in both the survey questions about working on financial plans, like paying off debt, but also we had a question of individual versus household income. In the questionnaire itself, the questions about financial well-being don't have any questions that are specific to providing income. They do have two particular items. One is, did they ask you your age, and they also ask you how you took the survey, the questionnaire, and the reason for that is to adjust the scores accordingly based on what we found were meaningful ways of answering those questions. But I think your question in particular, getting at the difference between treating this as an individual versus a family, that was an inherent factor in the development of the scale, which is, let's pick the process of choosing those 10 questions was an iterative process that began with 50 questions. Were narrowed down to those 10, and those were the questions that were we call them the most discriminatory. So questions that made people think, made people use this is subjective. It is a subjective measure. So when you answer those questions, if I'm a single individual living alone, I will be answering those based on what I have as my resources in my household. And if you're someone who's married, most likely that's how you're thinking. So, but we also know, as Janica said, this is subjective, but very strongly based on people's reality. It's what people know about their day-to-day struggles and their possibilities.
Yeah, to just maybe reiterate what Hector said in a slightly different way, if it's helpful, that really we're hoping, well, the scale has been tested, and it seems like it's a way to create a single number out of all these disparate variables, which it would almost be impossible for people to collect the specific data behind all of these issues. This is where it all comes together for a person and how they describe how their financial condition and their capability affords them with security and freedom of choice in the current moment and into the future.
I first want to just applaud you guys for working to operationalize something that's really hard to operationalize. And also, I think, for really valuably shifting the conversation from one about whether someone uses a bank or not to this much more holistic idea and conversation about financial well-being, which I think is the real goal. You asked about ways that we might use this in our work and other kinds of questions that might come after this or future research. I applaud both what Brent and Ann said about both income volatility and trying to understand how different products or services can move the needle for people. I also, and I haven't worked out how you would do this yet, but I think this could be the beginning of really thinking about internal, kind of behavioral versus external factors and trying to understand to what extent financial well-being is governed by the things that people can control versus the things that they can't control. And I certainly imagine myself using this, incorporating this with my research, with my own research, especially the longitudinal aspects. I wonder, and this I think connects with something Brian said about steering people to content. I wonder if there would be useful partnerships with, say, a Credit Karma or even a NerdWallet, where people are you've got an audience of people who are kind of trying to understand, say, their credit score or how they could use products better, where they could get to that tool and then be directed to content, so having that tool be delivered as part of an app or a service that people are going to for other reasons.
Thank you very much for the research. I primarily work with single mothers, and around financial education, financial coaching, and what we've really seen is that when they start to have hope that things can get better, that's when they are willing to take risks to change their behavior. Our focus is on managing their monthly cash flow, and as they start to do this and they stop paying late fees, and instead of having too much a month and not enough money, they start to have enough money and to correspond with the month. We just see huge behavior changes. And then the other thing we see is that as it builds their financial confidence, as that skill builds, their knowledge builds, it also builds confidence in other areas of their life, so they feel like their kids are acting better. And it's like, well, you're not stressed out of your mind. So I think by not having the wolves at their door, by having hope, by seeing progress in their lives, they're taking much bigger steps. They're going back to school. They're getting promotions at their work. So I think all these things kind of build together to move people forward and to participate in the American dream. And lastly, I'd like to think about how do we incentivize maybe savings and incentivize building saving nets or safety nets? Are there ways to get people to say, I know there's a Save to Win. We were the second state in the country to get Save to Win around credit unions. But I just think this is really, really important. And I just see the quality of lives of the low-income families I work with change dramatically when they start to have financial confidence, when they start to feel like they're moving forward. So thank you for your work. Let's continue to build this together.
Kathleen, Chi-Chi, and Will?
I spend some time with people who receive grants to do work in communities, and as probably many people here know, especially those who depend on grants, that there's been a real push towards standards to show that you actually have made a difference, which is really difficult to do when you're talking about community development, consumer counseling, and then grant makers get nervous about impact. Are these dollars really making a difference? And this tool would be incredibly effective, not only as it exists, but I can see ways in which it could be changed for different situations. So I really encourage it to get at, if possible, for you to get it as much as possible into entities that are obtaining grants. The second thing is the following up on something that Brent said. I think that the questions of income and outflows, it's both who in the family is contributing money, or at least whether the income should include all of the money that's going in the household. But also, if you look at things like the residual income tests for the FHA and the VA, they look at also how many people are dependent on the income. So if you have one person with a severe disability, a lot of income is going to be going towards that caretaking.
I had a statistical question. It seems that with 217 variables and what you said, Yannicka, about multivariate analysis, I assume the data isn't big enough to do regression. Yeah. Okay.
It is big enough to do regression. We are undertaking some of that ourselves, but I don't think we can get through it all alone. So again, we're urging others to take this up. I don't know if you want to mention something about the sampling that allows for.
So we have a sample of about 6,000, and with the oversample again of the older 62 and older population, it is true that you cannot run a regression with 200 variables, but some of those variables are part of a concept of a scale. So you have, for instance, a scale of financial skill, that those 10 become just one number. And so there are methods to handle some of those, and some of these are not just appropriate either theoretically in a model, or they're competing, they're trying to measure the same items. So there are strategies to narrow down, but yeah, it is appropriate for modeling, and we can talk in detail on what type of modeling we're using for understanding these relationships.
Great. And I have just one last question, which is, I don't remember a question on in fact, I know there's no question on the well-being scale about your actual income. So where did that figure come from?
There is no, the scale itself doesn't include income. The survey, which was asked to those 6,000 individuals, did have a battery of questions on income and other characteristics.
So that's an objective measure, not a subjective
Well,
measure?
it is still self-reported with its errors.
Thank you.
And so I just want to say that this is the opportunity that this scale has to be connected to other surveys. So we know already that the University of Southern California and their Understanding American panel has our scale included. And they have a battery of questions on many other issues that are not included in our surveys. More detailed information on retirement issues, but also on numeracy, other sources that are of interest to all of you. And also, we have groups that are interested also in using it for more administrative purposes, so connecting it with actual information on savings in a 401k. So this is part of the outreach for this scale.
So great research, of course, again, of course, from the CFPB, and great research on the last report, too. I forgot to thank you for that. I'm really looking forward to reading the entire report. I'm especially interested in seeing the correlations on race, because you're finding on the strongest correlation between liquid assets and financial well-being, of course, made me think immediately of the racial wealth gap, and the research showing that the average white family has about $100,000 in assets, and African American families and Latino families have a lot less, so 7,000 or 8,000, and something that Dr. Slaughter talked about and Ruby alluded to, that wealth gap always makes me, my theory is that it's responsible for a lot of the other disparities you see economically. The fact that, credit scores are lower for certain groups of color as a group, that's probably due to not having enough assets in emergencies to pay those bills to avoid becoming a debt collection item or a collection lawsuit. And this actually that finding about liquid assets kind of gave me hope, because, when you look at $100,000 versus $7,000 or $8,000, you're like, oh my God, how do we close that gap? And, there's new research saying that's going to go to zero at one point. And what this makes me realize is that, it's not making up $80,000, $90,000. It's just getting a $400 or $1,000 worth of a savings cushion that could really eliminate some of those disparities. And so, Anne, you're talking about a product that would help reduce debt even if it doesn't increase asset. And Neil, your point that maybe banks should be encouraged to do this. I would definitely echo that and remind the banks out there and the public that, these racial wealth gaps, this country is about to become majority minority. And if we don't close those gaps, or at least we don't get that $2,000 cushion to improve financial well-being, nobody's going to be making a lot of money. And so, maybe, in terms of financial education literacy, if you can only focus on one point, make it simple, it's, have that, focus on $400. Focus on that $400 cushion.
Just want to say, so yes, so Hispanic, it is an area of interest to me to pursue those distinctions between ethnicity and race that we found here. There's so many hypotheses that we could think of, like the role of family, community, and certainly even the meaning of financial well-being itself, and how you consider the future, what are the type of risks that you're exposed. And all of those may be part of what explain those distinctions. But I agree with you, when you look at the score by level of savings, those first few buckets, the score goes up so quickly. Already at having just 1,000, you're already at a score of 52. So yeah, like targeting that, it's great. I also just want to mention, I forgot to say that we are also working on a project with Catalyst, with Credit Karma, where we will be able to understand the relationship of this score with a credit score. And we also will be able to talk about other characteristics of consumers. And I think that will be a huge contribution, again, to this research agenda.
Great. I think it's important to note that banks are already part of the solution. We provide a great deal of education. Proactively, we work with not-for-profits to deliver it. And I think if we actually step back and tabulated all the education that's been developed by financial institutions and use that as an opportunity to work with not-for-profits, I think you'd be surprised at not only the depth but also the quality of what's out there. So I think that's the first thing. Secondly, I think it's important to note that banks, a healthy consumer is very important to us. So there is no disconnect between the banking industry and kind of the desire to do this. And I can tell you at Citibank, it's something we take seriously, both with what we already have developed, both for adults but also for young adults from a saving and education standpoint.
So William, one thing you should be aware of is the Consumer Bureau has sought to work in partnership with financial institutions on financial education, and we've had some success with that. We organized a partnership with the Financial Services Roundtable 2 or 3 years ago, and we did push forward on financial education efforts jointly. One of the things we came to see through that, which we were aware of before, but it really kind of documented in a much more tangible way, was, as you say, just how much financial education is being undertaken by individual institutions and by trade associations, but enormously across the country. The largest banks, the smaller banks, the smaller banks very involved in their communities, and the larger banks have foundation and other efforts of this kind. What we found that was something that we think could be improved upon is so many people have lots of disparate little efforts. It feels a little bit like the sort of peanut butter approach where lots of people do little things. Now a number of institutions were doing very similar things and using some of the same, Jumpstart or what's the enterprise junior achievement programs. There were certain particular programs that showed up a lot of different places, so they're providing a lot of support to allow those. But there's lots of very disparate, fragmented efforts. It would be great if there were a way to organize it better, and this Bureau seems to be the right place to look to try to organize some of that better. On the other hand, there will always be individual efforts by individual institutions. So But there is a great deal that goes on. You are absolutely right about that, and I'm sure all of it makes some difference. Again, we continue to think we need a more organized approach in this country, and almost certainly that is getting into K through 12 across the country, and that's going to require a lot of help and effort and support at the state and local level, where the Consumer Bureau as a federal agency is just not in a position to dictate any of that, and it needs to be more of a groundswell of effort across the country, with financial institution executives being leading voices in that if they want to be in their areas. And state banking associations, we've urged them to push hard on their legislatures, and some of them are and some of them aren't.
Thank you. As former chairman of the Consumer Bankers Association, why don't I take as a takeaway to work with the staff and see if we can maybe tabulate and bring it together from maybe a little better organized, and so it can actually be a tool for others to use. Thank you.
And this partnership showed that even though we might disagree on some issues, we can certainly agree fully on other issues and work very closely together, and there's no reason why that couldn't be the case.
On the issue of what the financial industry is doing, it's very helpful and promising that the industry is making that same shift that this research shows is so needed, from the delivery of a pile of facts to the delivery of opportunities to practice and develop skills that can be used again and again. And I commend you also to have a look at the FDIC's work on savings accounts, banks and schools, and other forms of savings accounts for young people who are too young to contract. So under 16s in particular, a lot of smaller banks participated in that. That is public on their website, and they did that as part of a partnership with us, where we're doing certain things involving young people and they're doing certain things involving young people. And this idea that kids get used to making their deposit every week or every month in the classroom, and that some of the young people actually got job opportunities out of it in the summer with the local banks, is very promising. Thank you.
Thank you so much to the CAB members, to staff. I think we could talk for many more hours about these engaging topics, and I think it just shows how interesting, innovative, and meaningful the research the CFPB is doing on such a variety of topics. So we're now going to break for lunch, and we'll resume the meeting later this afternoon at 2:30 p.m. Thank you very much. Oh, I'm sorry, 2 p.m.